Good morning, everyone, and good afternoon. I am Jacob Chaparro. We appreciate everyone joining here as we have some other folks here coming through. But first off, thank you for taking the time to join us on a busy Thursday afternoon, Thursday morning here. We're going to make really good use of time and discuss a couple of topics here, but a special thank you to our clients here who we value. We really come in here every day to work on our craft to better improve how we're serving you all in all different facets here. So appreciate you all for joining. For those that will be tuning in for the replay itself, thank you for those. So what we're going to go over, we're going to go over a couple of things here. We'll go over our strategies, our philosophy, how we're doing in terms of performance. There's been a ton of volatility here. We'll talk about, I think, something front in mind that has been with a lot of people, which is tensions overseas with the war and making sure that we distinguish the difference between the market and the economy itself. So I'll get started with going over our strategies here. A quick plug here before we look at the visuals here, as you'll see here some things. Just really quick, want to discuss our philosophy here. We're going to hold questions here after the 10 or so minutes that we present to you all. If whoever wants to stick around, we're happy to do so. But a quick understanding, really quick high level of our philosophy, how we go about investing. And there's really four things we look at when we make investment decisions. One is looking at things historically, understanding if there's patterns, if certain things that in the past have triggered certain other events. So we really like to understand seasonality historically, what things have done. The old saying of Mark Twain is history doesn't repeat itself, but it rhymes. And that is very much the case a lot of the time with investments. So historically, we look at things. Technically, we look at things as well. We look at charts, we look at graphs. Then comes fundamentally, we look at companies' balance sheets. Are they healthy? Are they in debt? Do they have good cash flow? Kind of look underneath the hood to make sure that they are good valued companies, or hopefully undervalued, right? That's primarily what we'd like to find. And lastly, we tie things into understanding current events. Where do we stand? Perfect example right now with, again, the war overseas, inflation, and making sure we tie all these four things into our investment philosophy here. So as you see here in front of you, we run four major strategies, and within these strategies, there's different risk tolerances within. The one you don't see here is our what we call Zenith Pro portfolios. That's our entry level strategies that are really meant for folks starting out, whether it's retirement or maybe some education planning here. So our ZIP strategy, our all stock strategy, our ESG strategy here is what we show. And as we look into the next chart here, just a little bit more detail on these strategies here. So ZIP, as the acronym shows, this is kind of our hallmark, long-standing, modern portfolio theory-based strategies here that most of our clients have and have had for a long time. Last year, we introduced this, which was the ESG strategy within our ZIP lineup of portfolios. We had a lot of clients talk to us about wanting to be socially governed environmentally. So we went out and created that last year. We've introduced that. Our all stock, which we'll kind of highlight a little bit here, something again we created last year that specifically only invest in individual stocks, not funds. And as we just talked about, the Pro series there for first-time investors. And I want to pass things off to Mr. King, who is based out of St. Louis here, part of our investment committee alongside Pablo, to discuss right now the geopolitical tensions here and what that matters to your portfolio.
Yes, so a major topic with the backdrop of inflation also being a major topic, and Pablo will get more into that. But when we look at geopolitical events, certainly we have a big one that came up in February here with Russia and Ukraine. So how does that affect the overall markets? Well, typically what we're going to look at is Russia being the larger of the two economies. what are their main exports? And in this case, we can see here that they're the third largest exporter of oil. And if we go on to the next slide, we'll also see that another big commodity who Russia is the main exporter on is wheat. So how does that affect not just the U.S. economy, but across the world, international markets, whether that's emerging markets, established markets like Europe? Well, it affects them a lot because their trading partners, especially in Europe right now for energy, they're looking towards other areas because that supply is being shut off. So in the U.S., oil's a very hot button topic right now because of the price we pay at the pump. The good news is in 2005, we peaked in terms of oil imports. So we're much more self-sufficient here, and we're realigning from the west to the eastern hemisphere to be west to west hemisphere trade partners. So kind of a vertical alignment is where we see the new trade routes going, just more reliability along that path. So the other thing I wanted to mention is that we look at precedent whenever this happens and whenever geopolitical events happen. And there's a short-term movement. You might have remembered in February that there's this precipitous fall off in the market, and then things came back up. And so you can see on this slide here, different geopolitical events, almost all of them after a year were positive. Now, the Arab oil embargo, negative 36%. The backdrop of that is inflation, and we're going to have to see how that plays out. But certainly this didn't help with inflationary pressures, having supply dwindled more or less with key partners. So certainly something we're keeping an eye on, but also there's optimism when looking at 12 months after a major geopolitical event such as this chart.
Nick, can you just comment really quick on something you said in terms of partnerships, with Europe being really in danger in terms of oil with the Russian conflict there? That presents opportunity, right? Because something's always making money here. So what can you tell us really quick about our partners down south of the border and of course into Latin America?
Yeah, so they're going to be looking for new partners. So things like liquefied natural gas, an increase. So you're going to look for an increase domestically here in production. We have to make sure we're taking care of ourselves in the home front, but also with agricultural needs. I mean, there's calculations out there that certain countries like Hungary or other Eastern European countries might actually run out of food soon because Ukraine and Russia, those trading partners, were taken away essentially from this conflict. And then South America is just viewed as a much more stable line in terms of trading partners with. And you're already starting to see some of those treaties be reorganized, reclassified within the U.S. to make them much more friendly and open up trade more.
Thank you, Nick. It's interesting because right now, European markets are down, domestic markets here are down. Brazil, if you want to look at something that's actually performing quite well, those Latin American countries for the year, actually their respective stock markets are really excelling quite nicely. So we'll shift gears, and Pablo, why don't you take us home here and talk about the distinguishments between the market and the economy, things that we're looking at here, and why it would be important for our clients to understand currently where we stand.
Well, thank you, Jacob. So basically, everyone is aware of inflation. Inflation is an all-time high of 8.5. So basically, inflation is the aggregate demand of the country is larger than the supply. So the supply basically has been a little slow because COVID restrictions, and demand has been larger. So that's the reason why you have inflation. So what the Federal Reserve is trying to do to reduce inflation, increase the interest rate in a more aggressive way. So basically, our clients are going to start to see the mortgage rate higher. Also, they see gas, which is oil, and also grain, which we have talked in the past before. So, and that's the reason why when everything is more expensive, the US consumer sentiment is an all-time low too. For inflation, also the stock market, no? But which are the positive part of the American economy? Basically, is there is plenty of jobs. The unemployment rate is an all-time low, and the economic activity is growing. So that's the part of the economy. And then how does kind of relate to the market? So basically, because all those, for many years we have had a low interest rate, which have helped the market, but now the interest rates are rising. So now you have all this sector which has more exposure to the interest rate rising, which negative return, like tech, small cap. Like year to date for the Standard & Poor's 500 is almost more than 10%, the Nasdaq plus 16. However, like we said before, there are positive sectors like energy, oil is an all-time high, grains, wheat, corn, and also in the economy, like there are sectors like utilities or staples or defensive sector like healthcare that they have doing better than the overall market. So that's important that we have to point out. And then Goldman Sachs has an equity sentiment sector, because many of the clients are asking, so we are at the bottom of the market, so maybe, we don't know, but maybe we are close. If you see in our slides, the current US equity sentiment indicator is an all-time low of minus 2.2. That has coincided with lows in the market. So in summary, it's like maybe if we don't have a recession in between 6 and 12 months, the return of the market in 6 and 12 months will be probably higher. So that's kind of the what we see.
Thank you, Pablo. Yeah, the difference, wherever you look, you can find always good and always bad. It's always the journey and the quest we're on to understand where the respective markets are going and find the investments, because something's progressing while some things are lagging. But our final outlook here to give you is, where do we go from here in terms of our stock market here domestically, the economy? There is high risk at this point, I would say, medium to high, of us going into a recession, maybe into next year. That does not mean, though, that all things are bad. The recessions happen. They're part of the economic cycles. Most of the time, the stock market is forward-looking. So we don't believe that the bottom of this current pain that we're going through is in just yet. Like Pablo mentioned, I think we're getting pretty close. The takeaway should be that I don't think equities, or we believe equities, probably don't find a footing, and they'll probably into the summer, into the second half, we probably start to see some stabilization. Now, word of caution here, that does not mean that we want to play the game and we're not trying to time the market here. All we're trying to do is identify these windows of time of when to take more risk, when to be more conservative. And that's why our investments, our performance are reflective of that, is because we're able to understand and hopefully forecast, where we should allocate more money. I'm not trying to time the market here whatsoever. We do at times like to raise some cash to just be more conservative. And some of the things that we're doing right now to combat some of the pain that we're seeing in the fixed income side of things, the bond side of things, is looking at alternatives, whether it be real estate, commodities, different things of that nature. So even with the respective stocks that you have, some stocks are more inclined to be recession proof. Some stocks, like growth stocks, are meant to get huge gains while things are booming. So it's understanding when to pull those levers, when to identify those opportunities. But the takeaway for the outlook is, we're not confident the bottom's in just yet. That's okay. Most of our investors, everyone I should say, is long-term, regardless if you're retired or not. So all things being what they are, long-term things will be fine. It's just making sure we're doing the work in between, like we are, to make the best of it. So I'll leave you all with that. Again, a special thank you for being able to join us and just to be a part of Zenith. We really enjoyed to do this. This was a request from clients to do these things live. We'll be doing this every third month. We'll be doing the live sessions. We'll post them on YouTube after. And the last thank you I will say is we always like to grow in community. And we would not be here 5 years later if it wasn't, again, for everyone who's introduced us to some of their colleagues, some of their friends, whatever it may be. We're looking to grow and continue to grow our business, finding the right people. So thank you for those that have done that.